How do I perform scenario analysis? Have you ever wondered how traders prepare for unexpected market shifts? Scenario analysis is a powerful tool that can help you understand how your investments might react under different conditions. This method is especially useful in options trading and risk management. Let's break down how you can perform scenario analysis effectively. First, you need to define your objective. What exactly do you want to analyze? It could be the value of your stock portfolio, an options position, or a mix of both. Knowing your goal will guide your analysis. Next, identify the key variables that impact your portfolio or options positions. Common factors include stock prices, market volatility, interest rates, dividend yields, and the time remaining until options expire. Understanding these variables is essential for accurate analysis. Once you have your variables, it's time to develop scenarios. Create a set of hypothetical market situations to test. Typically, you will want to include a base case, which is the most likely outcome, a best case for an optimistic view, and a worst case for a pessimistic outlook. You can also add other scenarios to reflected sudden market changes, like spikes in volatility or shifts in interest rates. Now quantify how these key variables will change in each scenario. For instance, in a worst-case situation, you might assume stock prices drop by 20%, volatility increases by 30%, or interest rates rise by 1%. These specific changes will help you see the potential impact on your investments. Next, calculate the expected values of your portfolio or options under each scenario. You can use option pricing models like the Black-Scholes model or binomial models for this. Recalculate option premiums and the Greeks, which measure sensitivities based on the changes you defined earlier. After calculating, analyze the results. Compare the outcomes across your scenarios to see potential gains, losses, and risks. This step is vital as it helps you understand how sensitive your positions are to market changes. It also allows you to assess whether your current risk level is acceptable. Finally, based on your analysis, you may need to adjust your positions. If the worst-case scenario indicates significant losses, consider hedging your options, closing positions, or reducing exposure. For example, buying protective puts can help manage risk in a declining market. Remember, scenario analysis is a form of what-if analysis. It helps you anticipate how different market events could impact your investments. The accuracy of your analysis depends on the assumptions and inputs you use, so be realistic in your approach. In options trading, scenario analysis can also help you examine how multiple factors affect option prices and Greeks. This understanding is essential for making informed decisions about your positions. By applying scenario analysis systematically, you can prepare for market uncertainties and make better decisions about adjusting your positions to manage risk effectively.